Hi everyone. Happy Thursday, September 5th. It's about 9:30 in the morning on the West Coast, and it's time for another market update. Rates have been on a nice little run since the Fed. It's been apparent the Fed's going to make a rate cut coming up at their September 18th meeting. A lot of important data between now and then. Starting with last Friday, we had inflation, and then jobs week this week. So let's get right into it. The first thing we got was July PCE numbers. So this is the Fed's favorite form of inflation. They especially like the core number, and then this came in the headline number with everything included came in at plus 0.2% month over month. Year over year was up 2.5%. The expectations, it was both in line with expectations. The year over year number a little bit lower. It was supposed to come in at 2.6. Core was expected to be 0.2. It came in at plus 0.2%. The core was expected to be at 2.7 and came in again a little bit lower at 2.6%, which is good to see. Looking at that in graph form, we can see it's way down from 2022 when it was above 7%. Keep in mind the Fed wants to get this core number down, this blue one line down to 2%. Like we've talked about, that's going to be pretty tough with month over month comparisons, upcoming. But if you analyze the number, the 0.2, month over month number, that's about 2.4% for both the core and the headline, which is pretty low. Not as low as they want, but again, it might be hard to get to that 2% number. So the next thing we got was, like I said, it's jobs week. So the first one we get is the July JOLTS report, which is job openings. And that came in lower than expected, and they actually made a negative revision to the previous month. So the previous month was about 8.1 million. They revised that down to 7.91 million. This month they said was going to come in at about 8.09, came in at 7.673. So between those two numbers, definitely came in lower than expected. Actually lowest since January of 2021. So again, looking at this one in graph form, down from the 12 million high number a couple years ago. Level of layoffs jumped this month as well. So that's, again, a sign of possibly a weakening labor department or labor market. So overall, not necessarily good for workers that got laid off or didn't get the job opening that they wanted, but good for what we're looking at because the Fed is looking at this and thinking, hey, the job market is weakening. Maybe we need to cut rates, which it looks like they're going to do. Next thing we got was August. This came out today. This is the August ADP payroll. So this comes from private payroll data. It was supposed to be about 140,000 jobs created. Came in at 99,000 jobs, which again is the lowest number since January of 2021. So a little bit of a coincidence there between July JOLTS and the August ADP, both lowest since January 2021. So good sign for a weakening labor market, which we need. Taking a little bit closer look at these internal numbers, the headline, the one that jumped, created the most jobs was education and health services. Makes sense. They'll be hiring in education in August. My daughter went back to school today. So, kids went back to school across the country. So that makes sense. There'll be job gains there. Construction still strong, plus 27,000 jobs. Financial activities, maybe with rates lower, stock market active, they would be hiring there. And then the pullback would be from looks like professional business services, manufacturing, and information industries. So overall, good start to jobs week for us. Challenger's job cut, which is corporate layoffs, came in about expected, 75,000 cuts. BLS is Friday. We'll talk about that. But overall, good start to the jobs week because we need these numbers to be pretty moderate to weak to keep the Fed, headed in the right direction. Next thing we got. This one came in a little lower than expected. Initial jobless claims supposed to be about 231,230. Came in at 227,000 new unemployment claims. Continuing claims is still about 1.835 million, I think. So overall, it looks like employers are still trying to hold on to employees and resist laying them off, but definitely a weakening labor market overall. So that's again good for where we want the Fed to look at. Next thing we got, average 30-year conventional is about 6.35% for top end borrowers, according to this lender survey, down from 6.41% last week. I believe the low over the last year is about 6.33, 6.32. So we're pushing our lows over the last year. Be nice to break beneath that number. Upcoming jobs report tomorrow probably could do that, or will push us away from that depending on how it comes out. So head in the right direction. Definitely down from above 8, which was also a high point this year. So good things are on the horizon. Next thing, important dates. Like I said, tomorrow we get the BLS jobs report. It's expected to add about 165,000 jobs. Unemployment's expected to stay at 4.3%. So if you see on the news that that number came in lower than expected, less jobs created, if you heard about unemployment going above 4.3%, that would be something that would be good for mortgage rates. Because again, it would, the weaker the labor market looks, the more likely the Fed is going to cut rates more often to stimulate the economy. Next week, we get two inflation reports. We get the CPI and the PPI for producers. And then the week after that, on September 18th, is when we get the Fed, their next meeting announcement. And right now, it's about a 60% chance the markets are saying that, they'll cut by a quarter point, 40% chance that they'll cut by a half a point. The expectation, again, I would expect just a quarter point. So, but it also depends on that jobs report tomorrow, inflation reports between now and then. But overall, things are heading in the right direction. So it's good to see. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, everybody. Thanks a lot.